CNBC TV18, embarking on a quarter century of excellence.
Let's take a look at what the Asian markets are doing right now. They are largely mixed.
If there is enough stocks available, that will give us comfort. So I think that's the primary criteria.
For the Nifty, just to circle it all back to what it means, the upside target remains 2150 to about 21100.
Here you go. There's the first tick on the index. Very quiet.
Energy transition remains one theme that we very strongly believe in.
Big picture, I think very positive for the sector.
As of now, we are anticipating that maybe there could be an escalation to a warning letter.
We've seen some faltering of those gains now. The Nifty's dipped below the 21,000 level.
They do not think there's any clarity on new tenders for B-heavy molasses.
So looking into that, our first motive is how do we crush more and convert more ethanol.
2019 exercise, the abrogation of Article 370, contentious, polarizing issue being decided finally, the Supreme Court upholding that abrogation.
The market, it's a quiet day so far. As far as the benchmark indices are concerned, a 10-point uptick on the Nifty.
Okay, that's a day so far. The market's up 27 points. So relatively speaking, it's a bit of a quiet day. You're with us here on another edition of Closing Bell, first day of the week. I'm Prashant. With me, my colleagues Nigel and Reema. Guys, hi. Afternoon.
Hi, afternoon. Good performance by the mid-caps yet again.
I mean, mid-cap index is up, I think, about 0.6. Small-cap index is up 0.75%. So I think it's that part of the market is absolutely just fine. So, you know, it's just, I mean, some parts do well. Like, for example, last week, mid-caps and small-caps took it easy, while the frontline indices did 3.5% and 5.5% respectively on Nifty and Bank Nifty. It was 1%, 1.25% in the mid and the small-cap part of the market. Today, the Nifty is taking it a bit easy, and the broader markets are doing much better, but quiet. I mean, actually, we saw this even on Thursday and Friday, the last 2 days. Monday, Tuesday, and Wednesday were all in the last week, basically. The markets went completely berserk. Thursday, momentum faded. Even Friday, you know, we corrected a bit before the market picked up, and we ended about 70 points higher. And I think today is a bit of a repeat of what we've seen over the last 2 sessions or so. So that's what's going on. The Bank Nifty is up about 1/3% on your screen. Just a couple of points before we go any further. For the Nifty, I mean, I think the levels remain the same, 21,100 on the upside and 20,850 on the downside. 2850 is nothing but basically the lows that the market has seen over the last 3 sessions, Wednesday, Thursday, and Friday. So the lows came in around that level, and that's basically where I think one should expect that the index to find support. Otherwise, I mean, you know, real estate is doing well, metals are doing quite okay, and of course, PSU banks continue to be the top sectoral gainers, you know, at this point in time. Market breadth is positive, about 500 stocks separating advances and declines. So it's a pretty healthy looking screen, even though at the frontline index level, it has been a bit quiet from the word go. Reema.
Quiet is about 100-point range on the Nifty, but the mean has been around the 21,000 level. Mid-cap action is good. The advanced decline ratio is strong. We've got about 1,900 stocks in the green for about less than 1,200 stocks, which are currently declining. Sectorally, pharma has been under pressure, led by Dr. Reddy's. Dr. Reddy's is the top Nifty loser, a cut of 5.5%. But on the other hand, on the other side of the spectrum, PSU stocks continue to flourish. PSU banking index, 1.5% gain, while the CPSE index, too, higher by more than 1%.
Well, that's right. You know, I think for me, the most heartening fact is the way the Nifty Bank continues to outperform. Even in today's trading session, it's up 0.3%, while the Nifty is up 0.1%. And that's really been the trend for the last week or so. If the Nifty Bank can continue this outperformance, well, that's going to be a big booster shot, actually, for the bulls. And it's hard to see the markets correct if the Nifty Bank is not going to see some kind of weakness. So good to see that index continues to chug along, moving gradually towards that 48,000 mark, and then maybe northward from there as well. Mitesh Thakkar is with us. Mitesh, what do you make of today's trading action? A quiet but a good trading session if you have exposure in the broader markets.
Good afternoon, Nigel. So I think it's a good session in the sense that, you know, we are at all-time highs. We've had a rally in the last about 9-10 sessions, and we are not giving our gains off. It's just that, you know, while it's a quieter session, it still is positively biased, and there are no signs of weakness or distribution happening. So I think that's a positive thing. And therefore, I think, you know, we can safely assume that this uptrend will last. And if you get a dip between that, I think that would be a welcome buying chance. Today, I think it's the Nifty IT, which has come into some kind of an action, making a fresh swing high. The last high we got was 33,400, which was on the 15th of September. And we had a closing of 33,390 yesterday, and today we are continuing. So I think that could add more strength to the Nifty. I have, in fact, a buy on Oracle Finance. Disclaimer, it's been recommended to our clients, so there's vested interest. But OFSS is a buy from the sector. Keep a stop below levels of 41.70, look for targets of 43.20. And the other one is Tech Mahindra, again from the same sector. That's a buy with a stop at 12.20 for targets of 12.65.
Okay, thank you very much for that. Dipan Mehta of Elixir Equities is with us now. Dipan, we've been talking about IT and there's no really fresh development to once again, go back to that topic. But thoughts on IREDA, 20% up on that. What have you made of it now?
Garima, good morning. Good afternoon, and thank you for having me on your show. I think it's a new listing, and some amount of follow-up or average buying must be taking place over there. See, the business model is pretty decent, and renewable energy is one investment phase, which is keeping on growing, and there's good demand for funding over there. And IRD, of course, is a specialist in that count, and they understand the business very well, and they're able to allocate capital effectively. Overall, I think we're pretty well managed company, and therefore investors are bidding a higher and higher price to earnings multiple, price to book valuation ratio for this particular company. But in my opinion, I think at these levels it is pretty much well discovered and well priced, and I'd wait for a correction. Within the NBFC and the financing space, I think there are many attractive opportunities, particularly in microfinance or in PSU banks, or even in large cap banks if you don't have the risk appetite. So I would just wait and watch as far as RD is concerned.
Okay, do stay on. We want to turn our attention now to the sugar sector. Sugar stocks have reversed losses which were seen in the last few days following the government's move to curb the use of sugarcane juice to produce ethanol, at least for this season. The Petroleum and Natural Gas Secretary also met with the Sugar Mills Association, and they said that sugar production is in full swing currently and they do not foresee any fall in sugar production. The industry body is also expecting some relief by evening. Sonal is here to tell us how the government's measures in their current form could impact sugar companies. Sonal.
Thank you so much for that. Well, sugar stocks, they've definitely been under pressure with the likes of Balrampur Chini down 16%, Praj Industries down around 16%. This is a company which is a provider of technology for ethanol production. Dhampur Sugar down 17% and Dwarike Sugar down around 8%. The news that led to this is that government has asked sugar mills not to use sugarcane juice and syrup for ethanol output for 2023-2024 season. But supply of ethanol from existing offers received by OMCs from B-heavy molasses will continue. Now, in terms of numbers, 65% of ethanol production is via B-heavy molasses, 25% by sugarcane juice, and the rest, that is 10%, by C-heavy molasses. What will the impact of this move be? Well, sugar production will increase from 29 million tons currently by around 2 to 2.5 million tons. The move was actually taken due to a fear of sugar shortage in the country. Second, sugar volumes, they will not change as demand will be stable. This is Elara Capital's view. Third, sugar prices are expected to decline due to more supply. In fact, Balrampur Chini told CNBC-TV18 that sugar prices could see a decline of at least 5% from current sales price of 39 rupees a kg. Fourth, ethanol volumes are likely to decline for companies which have juice ethanol capacity. Now, ethanol is usually the high-margin business for sugar companies. Elara Securities told CNBC-TV18 that they expect first half of FY25 to be negative for sugar companies with juice ethanol capacity. And ethanol volumes, they could decline by 20% in the first half, with overall EBITDA declining by around 4 to 5% over the next 18 months. There will be no impact on FY24 numbers, but we could see that in FY25. According to them, C-heavy ethanol and B-heavy ethanol have better margins, but they want to see what is the impact on operating leverage and also on fixed costs now that ethanol capacity will be idle to a certain extent. And also, Balrampur Chini had spoken to us on Friday, and he said that the projects or the contracts that has been tendered till now for B-heavy molasses will be executed, but they do not think there is any clarity on new tenders for B-heavy molasses. However, the company, like other industry experts, thinks it is a temporary move, and this is exactly what the Secretary Consumer Affairs told CNBC-TV18. He said that review is a constant process and they continue to review production numbers. They have a meeting every week and they can change the numbers and the production levels if required, the outlook that is. Domestic availability of sugar is the supreme criteria for the government, and stock at the start of the next season coincides with festive season, and hence they will track this very, very closely. They also say prices are expected to remain in control because of the action which has been taken by the government.
Okay, Sonal, thanks very much for that. That's a saga so far. You know, let's actually quickly listen in to an excerpt of our conversation that we had earlier with the association, the Sugar Association, Aditya Jhunjhunwala, president of ISMA, Indian Sugar Mills Association, after their meet with the Petroleum and Natural Gas Secretary. Listen in.
As ISMA, we have already saying that we have enough sugar available in the country and there's nothing to worry about. The current balance sheet, which we say is approximately, if we say our opening stock of 57 lakh tons, then the production, which is ranging approximately 325 lakh tons. Taking our consumption to 285, we still have that room for diversion of 3 million tons. So I don't think there is something to worry upon on the production side.
Okay, even Dwarikesh Sugar has made an announcement to the exchanges. They're saying the recent directive will impact our ethanol production process. We've transitioned to using B-heavy molasses as feedback for production of ethanol. We have the necessary infrastructure in place for this transition at both the units, but the financial implications stemming from this recalibration is unquantifiable. Dipan is still with us. Dipan, stocks have found some relief today. They've recouped some of the losses over last week. But how would you approach this development from a stock point of view or an investment trade point of view?
No, that's not a very positive move from the sugar industry perspective. And such kind of policy flip-flops are going to affect investment into ethanol plants going ahead. That's the feedback we get from the sugar companies. Because earlier sugar companies were encouraged to set up more and more ethanol capacity to match the aggressive targets for ethanol blending. And now that this move has come, I think a lot of sugar companies will do a certain rethink. And from an investor's perspective, it just opens up a new era of uncertainty, which we best avoid at this point of time. So in my opinion, it's better to stay away from sugar stocks at this point of time. And one doesn't really know how this plays out. But the fact is this policy, changing, that certainly will have a longer term effect on the sugar stocks. We were just about valuing these companies based on ethanol and consistency in earnings. And now they go back all the way to being cyclical stocks with low price to earnings multiples.
You don't think this could be an opportunity though, Dipan? I mean...
Not surely, Prashant, because if the government is going to take such steps from time to time, tomorrow God knows what next step they will take, and they may go back on the ethanol blending target also. So in an industry where so much of government interference is there, it's best to avoid, in my opinion.
Okay, what we'll do is we'll take a quick commercial break here. We'll come back and we'll also have Jigar Mistry from Buoyant Capital joining in the other side. Stay tuned, coming right back.
CNBC-TV18, embarking on a quarter century of excellence. CNBC-TV18, embarking on a quarter century of excellence.
Welcome back. Some mid-caps which catch your attention. One of them is Dixon Technology. The stock is up nearly 6%, pretty large volumes. And the other one is Intellect Design Arena, where the company has won 2 orders in a span of just 48 hours. One is with a very large Central and East European bank called OTP. We chatted with the management and they said the value of this deal is estimated to be 1,000 crore rupees over a 10-year period. And the other one is a smaller deal with the PSU bank in India, and that deal size is valued at about 100 crore rupees, again, over the tenure of the deal, which is estimated to be about 10 years. But some deal wins keeping the stock up afloat. The other one on our radar is Wockhardt. The company has completed phase 3 of a pneumonia study of WCK4873. Ekta joins in with the details. Ekta.
Thanks for that. Well, yes, important news for Wockhardt because they have successfully completed a phase 3 pneumonia study of one of the new chemical entities which is in their portfolio, which is called nifty or WCK4873. Now, according to them, the study has showed ultra short course of the drug or a 3-day treatment is as effective as a 7-day therapy of a drug which is normally given for pneumonia and serious cases, which is moxiflox. Now, in the phase 3 study, they have indicated that a 3-day treatment with nifty resulted in a clinical cure of 96.7% of patients. This is versus a clinical cure of 94.5% for the other drug. Now, the phase 3 study also did not encounter any serious adverse events. The phase 3 is in line with a phase 2 study conducted in US as well as Europe. Now, the company says that they foresee a significant opportunity in India as well as emerging markets for the drug. They will be filing for a drug approval with the DCGI in the next few weeks. And in India, nifty would probably see a commercial launch around mid of 2024. They are also possibly exploring out-licensing opportunities with companies when it comes to this particular drug. Now, remember that in the NSE portfolio, they did make waves recently because WCK5222, which is another antibiotic in their portfolio, they've indicated that they completed 10 patients for compassionate use after the approval of the usage by the DCGI, which resulted in a 100% cure and was found to be safe even when administered up to 60 days. So one really needs to see the effectiveness and the sustainability of this drug in the next couple of months to assess the commercial opportunity for it. As of now, the street is anticipating that it might be a big opportunity for Wockhardt.
Ekta, thank you very much for that. The early results seem to be very promising, as Ekta pointed out. Earlier today, we had a chat with the company's chairman, Habil Khorakiwala, where he discussed about completing phase 3 trials for nifty. Listen into what he had to say, and he even spoke about the opportunity.
We have completed phase 3 clinical trial. And I think in my press release mentions about the incidence of death, and it is after nearly 30 years, a new macrolide, nifty, has come to the world after azithromycin. This would have a fairly significant opportunity in India and in emerging market. Mainly because the resistance levels are high, and simultaneously we will be working on with various companies for out licensing it out so that we get the maximum potential. So in India, we hope to launch in next couple of quarters once we get the DCGI approval. And I think worldwide it would be sometime in about 12 to 18 months.
Well, the other big stock is Polycab. It's dethroned Havells as the most valuable wires and cables company here in India. In terms of listing, well, Polycab is a recent listing. It listed in 2019. While Havells, the listing date dates back to around 2001. In terms of market capitalization, well, in today's trading session, post the move that we've seen, Polycab's market cap is more than Havells. And year-to-date performance, Polycab has been a big outperformer. It's up 120%. Havells is up only around 20% approximately. But you'll be wondering, what were the key reasons for Polycab to re-rate from here on? One is the industry tailwind. The cables business, well, it's seeing good amount of demand, both from the local as well as the global market, with capex picking up. Next up, the product mix. Polycab is a higher share of revenues from cables, while Havells mix, well, it's skewed more towards wires. So in that sense, they are gaining more. That's why Polycab is standing out. Now, consistent capacity addition is something that has held Polycab well. Because we hear about a lot of these cables companies, they say we're functioning at optimal capacity utilization levels. But Polycab, they have that headroom because of the proactive capacity addition by the management. So that's why Polycab has done well. What's ailing Havells though? Well, Lloyd's turnaround is taking longer than expected. The consumer discretionary spends as well have been a little bit softer than expected. And that's why the ECD business, that's been struggling a little bit. And the lighting business has been under pressure because lead prices have been under pressure. Now, Polycab has seen a big run, but even after this run, because of the suppressed profitability of Havells, we are seeing that Polycab is still trading at a discount in comparison to Havells. So the big headline today is Polycab has pipped Havells in terms of the most valued company in terms of market capitalization among the cables and wires space. That's the big headline for the day. Well, Deepan is still with us. Deepan, what do you make of this one? Do you think Polycab still has legs to further outperform from here on? Because the sector tailwind is something that's holding them well. And also they have clearly stated their 2026, 2027 targets as well. Your take?
Yeah, no doubt about it that the company has performed really well on listing. And if you look at the quarterly numbers, they've been far superior compared to Havells. But Polycab still remains largely a cable company. And if you analyze the numbers, the other appliance business has not grown as fast. It's just that cables have done really well. And that's true for Havells, that's true for KEI also, and Funlex Cables. This particular industry has been on the upswing because of increased real estate activity as well as infrastructure, as well as power distribution has led to increased demand for cables. But I think it's pretty fairly valued for a B2B type of a business that as mature industry as cables. Paying 40 times is just about enough. So I wouldn't like to buy either Havells or Polycab for that matter. Havells could be interesting if the other appliance business starts to do really well, especially air conditioners, which they have picked up, a few years ago. That's not really shaped up as well.
All right. Deepan, we'll leave it there. Thank you very much for joining us here on this edition of Closing Bell. Appreciate your time here, as always. Jigar Mistry is now joining us. He's, of course, with Buoyant Capital. Jigar, it's been a while since we spoke. Thanks very much for your time. Good to see you here. So what are the smart folks at Buoyant doing, Jigar? Are you sitting on a lot of cash? Are you all in? Did you go? I mean, just tell us a little bit about what you've done, because I mean, we had a momentous week, the last one, with very large moves, and I mean, it's not as if things were not looking good before, but now it's kind of entered into another realm in that sense. So what have you been doing?
Yes, good afternoon, Prashant. Thank you as always for inviting me on your show. I think we'll take a step back and realize what all has transpired. Right? The first thing is that BJP secured a reasonably good win in 3 states. But go back and check, you find that there were some 224 seats where BJP had a 50% plus vote share, even in 2019. Secondly, you will realize that the US yields have fallen from 5% to, I think, 4.19 at the bottom, 4.2 something. But there again, you go back and check and you realize that probably the interest rates are likely to stay higher for longer and not just high up and come down again. So if these two are the reasons why sort of the markets have done so particularly well, in fact, I was just checking the data before I came here. It was somehow very difficult to lose money in the last 6 months, right? So if you look at the data of the 1,500 companies, more than 500 crores in market cap, only some 60 of them are actually down. 250 are up more than 100%. And I think 3 of them are up more than 5 times in under 9 months. So I think it has been a great sort of run up to this. But, look at the rolling return data for, say, a small cap index, for example. Every time it has been in the 35% plus handle. It happened 3 times before, 2007, 2011, and then 2017. the next 2 years returns have historically been a negative 35%. So while it is, the recency bias is great and we are getting carried away, small mistakes can happen and that have very large repercussions. So our sense is that it's time, I've been saying it for the last 1 month or so, and the markets have actually done fairly well since then. But I think the easier thing to do is actually, sort of get a little more defensive in the scheme of things and take it up from there.
So to get defensive, are you booking profits in parts of your portfolio? And if yes, which ones?
Right. So, see, we used to be almost 65% or small and mid cap exposure. After March, those stocks have done phenomenally well. And we have sort of taken all the incremental money, sold some of the older positions in small and mid cap, and are deploying a lot more in larger caps. Largely financials and banks, pharmaceuticals is where we find some amount of opportunity on an absolute basis. But that small and mid cap as a proportion for us has fallen below 40%, which was at peak, I think 60 or 65%. So one is the tilt that sort of we are following. The second clearly is in a managed account sort of scenario, which a PMS is. We are telling incrementally investors that will take time to fully deploy this capital, right? Because investors either try and time the market. None of us are good at doing that. So the better way to deploy capital, if you are raising more, is to sort of spread this out over the next few months, and that way you don't really have to sort of see if it makes sense at this point in time or not.
So other than deploying the money that you've raised by selling your stake in some of the small and mid caps, other than investing it in large banks, is there any other place where there is relative comfort to invest at current levels?
Yeah, pharmaceuticals is reasonably good, but look at all the sort of sectors which are doing well from an economic standpoint, and which go back and check what the market is forcing you to assume. We are increasingly getting into this too hard to sort of price in territory, right? Capital goods, a reasonably decent space, you're likely to see more orders. The valuation leaves a lot of sort of area for discomfort. Same way, like drones, interesting places, but hardly, if at all, any companies trading at very high valuations. New age tech businesses, again, they have moved, we had some exposure earlier, but incrementally to see a lot of them report, 5,000, 7,000 crores in profitability to justify a 1 lakh crore plus market cap on a steady state basis is getting a little trickier. Not a lot of sectors. Specialty chemicals are seeing a reasonably good cyclical downturn, so at some point they might become interesting. But at this moment, very difficult to find opportunities to deploy a lot of capital.
All right. Hi, Jigar. Good afternoon, and good to see you. And we're speaking after a while. Jigar, in your earlier avatar, you were quite a master in the metal space. How are you all positioned out there? I recall we would have spoken in the past to get the last few months of the calendar right, and the early few months of the calendar right, and the full year you can go and just travel. If you get that timing, those 4 crucial months, then you're off to the races. This time around, how do you think things are panning out, and what is your positioning in the metal space?
Yeah, Nigel. So we used to discuss on how you should buy in November, sell in February, and just make hay while the sun shines later on. But again, see those sort of super cycles in metals, because the markets have become very, very sort of localized as we speak. It started with China earlier importing a lot of material, and therefore things were great. Then China started exporting, and all economies started creating virtual walls, right? So it started with Europe first, then US came in, then India put up the minimum import price. So I think all those spaces are where you completely localize the market. Demand supply from China became increasingly irrelevant, and that way you are starting to track local issues now. So for the past 2 or 3 years, I think that relationship we had created a very nice heuristic on sort of ceases to exist. In that scenario, it becomes sort of a case-to-case basis, right? There are times when a few companies here or there do offer some interesting opportunities, but with companies and sectors like metal, the best money is made when sort of the management has also thrown in the proverbial towel. That way, you're able to pick a lot of businesses at throwaway valuations and then generate return for 3 or 4 years rather than trying to pick up the 20% upside. So today, it's not even our top 10 sector as we speak. Cement, on the other hand, is interesting. The other sector we used to talk about, and there, with the M&A picking up, that sort of looks like an interesting, continue to remain an interesting bet.
On cement, you're like what? Large or mid cap or small cap? What is it? Working for? You believe there's more consolidation in play?
Eventually, there will have to be, Nigel, because see, you look at the current sector, it's a very unique sector in that there is a strategic discount on M&A, right? You have to buy, if you buy a large cap cement name that trades at a premium to the M&A deals that are happening, it's hard to find any sector where this is prevalent. So that way, it's better off. You're better off as a secondary investor to buy companies which can translate into a sort of M&A candidate rather than picking up companies that would be acquirers. So long-term EV to EBITDA PE ratios still don't make sense, but that is sort of interesting space in the cement, especially sort of less than 6 months into the general elections as well.
Jigar, talk to us about one idea that you like and you're backing, with of course all the disclosure, etc. But something that looks interesting, and why?
Sort of the last time, Prashant, we did speak about 2 or 3 companies that we have added recently. Aavas Financial was one, RR Cable was another, ICICI GI was the third one. So I think within the sort of space, banking continues to remain the best possible play. I would say HDFC Bank, it's for the first time in 7.5 years that we have been running Buoyant. It's come to the top 3 positions, and I think that business, people have, it's sort of one step away from being a meme stock, and sort of once it acquires that status, the stocks tend to do fairly well on a lighter note. So I think HDFC Bank, given the consolidation, given the management changes, all of that is, I think, now behind, and we might be surprised over the next 1 year with what this seemingly boring stock can actually deliver.
Okay, that's and of course the others that you mentioned, RR Cable and the ICICI GI, etc. Those you still like, right? Aavas, etc.
Yeah,
you still own.
Yeah, so that is sort of in October, the webinar that we presented as the 3 largest positions over the past 3 months or so.
All right, Jigar, we'll leave it there. Thank you very much for joining us on CNBC-TV18. Appreciate your time here, as always. I think we'll take a quick commercial break here with the news that Nifty is up about 30-35 points. We are exactly at 21,000. As we do that, we take that break. We'll come back. We'll get you what's happening in dealing rooms, D Street Chatter with Nimish coming up in just a bit, our technical trading ideas after that. Stay with us.
CNBC-TV18, embarking on a quarter-century of excellence. CNBC-TV18, embarking on a quarter century of excellence.
Welcome back to Closing Bell. Well, it's that part of the day when Nimesh joins us to tell us what is he picking up in terms of dealing room chatter. Nimesh, fill us more.
Hi, Nigel. Again, it's a day of consolidation, but the broader markets continue to outperform. In terms of flows, again, it's a mixed day because there is a small market at close. Sell flow as well at a leading FIDs, but broadly the flows are biased towards the financials, and within financials is the private banks which are well bid for the third or the fourth day running. So clearly now from here on, there is a bit of bias towards the private bank stocks, at least from the larger institutions. That's the general sense I'm getting in. In terms of sectors, OMCs, after a big move in the last many days, that has seen some bit of profit booking today, and largely there are fears as well that maybe you'll see some retail fuel cuts. So OMCs are under pressure, but broadly from a flow perspective, it's mixed. But it's the financials which are well bid from the larger FIs, even in today's trade.
Nimish, so that's the overall sense. In terms of specific stocks, so what's on your list?
Well, as I said, the private banks are well bid. The first name on my list today is Kotak Mahindra Bank. It's been buzzing in the last few days, but again, in today's trade, there are very strong buy flows, is what I understand. So expect high delivery volumes in Kotak Mahindra Bank, and looks like some serious investors, FIs, are turning buyer in Kotak Bank. So that's the first one. The second is I'm expecting a couple of QIPs this week. So that includes the names like SW Solar, which is likely to come out with a QIP maybe today or tomorrow. Even J&K Bank is lined up for a QIP this week. So maybe even that will come up in a day or two. And the last one is Indian Bank. So all three are buzzing off late, but expect QIPs in all the three companies, which is SW Solar, Indian Bank, as well as J&K Bank. The third is Piramal Pharma. There was a large block, nearly 60 lakh shares got changed hands in a block deal today. In terms of buyer, I understand a domestic mutual fund was a buyer in today's block, and an FI was a seller, so disclosures could be interesting there. And the last one is SpiceJet. Big move in that stock and on large volumes as well. Remember, the board meeting is scheduled today for a fundraising. I understand some large market investors, including a US-based fund, is likely to invest in SpiceJet. So that's the reason why SpiceJet is buzzing in trade today.
Is interesting. Large US-based fund as an investor in SpiceJet. I mean, by the way, we should tag it to the BSE, the stock price, SpiceJet. I think the last I checked, it was some 10-11% higher. Yeah, there you go. It's about 66. Anything else you can tell us, Nimish?
So it's going to be a large dilution is what I understand. So the market cap of Spice is around 4,000 crores. The buzz on the street is maybe they'll raise between 1,200 to 1,500 crores, which would mean more than 20% dilution. So that's one part, that the dilution is going to be quite high. And in terms of investors, I understand it's going to be a clutch of investors who are going to invest money. So it's not a single buyer or one or two buyers, but there are going to be a clutch of investors. And within that, one large US-based fund is what I understand is going to be an anchor investor in that book. So I think that's the reason why the stock is expected. Some big names are likely to put money in SpiceJet. So it will be a validation that there is some bit of liquidity now for the company to survive.
All right, Nimesh, thanks a lot for joining us and giving us all of those details. One day post his birthday, and he is on the ball with all the details. Nimesh, the 18th birthday year in CNBC TV18. Wish you the very, very best, and fantastic year coming up. I don't think I know anyone in business news who is more on the ball than Nimesh over the last many years. So have a good evening, Nimesh.
Thank you, Nigel.
Well, let's move on. Let's get Mitesh Thakkar back in to tell us what to buy or sell for a reverse trade in the next few days. Mitesh, this market, the headline index refuses to go down. I don't think we have even seen, a 100-point or 120-point cut in the last many sessions. All dips getting bought into. View on the headline index as well as a couple of picks.
Good afternoon, Nigel. I think that's what, is the good point, that after rally, we are not giving away the gains. We are just consolidating. So while, today's action and on Friday, I think, we had some profit booking. We haven't given up any serious kind of gains. So I think that suggests that there will be more upsides to come. Maintain a positive stance. I have a BTST on Shree Cement with a stop below 28,100 for targets of 28,650. And Steel Authority, sale is a buy, or BTST with a stop at about 99.5 for targets of 103.
Okay, so that's those are individual names. By the way, Mitesh, on SpiceJet, chartically, anything you're seeing?
I haven't been tracking it, Prashant. So sorry.
Okay. All right. Well, this time when, as Nimesh said, maybe, later today and the deals data, the block deals, etc., we'll figure out what those funds, etc., are. Now, Dr. Reddy's is down sharply. It's been down since the morning, started 6.5% lower. And there's some bad news at the margin. Ekta is here with more. Ekta, take it away.
Thanks for that. Well, the US FDA had inspected the company's Bachupalli facility in October of this year and issued 10 observations. Now, those 10 observations have become public, and the street doesn't like what it sees. Now, just to give you a sense in terms of what the facility contributes like, it's around 30% in terms of contribution to the company's US revenues. It manufactures 4 of the top 10 products, which is generic versions of drugs such as Nexium, which is, a gastric drug, Ciprodex, Valsite, as well as Toprol, many of them cardiac drugs. Now, Antique has written on it, and they say that some of the observations are severe and can lead to a warning letter. For example, they've highlighted observations 1, 2, 4, 5, 6, 8, and 9, highlighting issues such as out of specification, which means that the drug, when it was tested, did not meet the specifications which was required, contamination, data integrity in observation number 7, and market complaints. According to them, this particular facility remains one of Dr. Reddy's critical sites, manufacturing over 100 products, and hence the risk is that it could probably be escalated to a warning letter. The street is probably going to watch out for the classification of the facility, which could take place in the next couple of weeks. If in case it is an official action indicated classification by the US FDA, which generally happens 3 months into the inspection, then it's probably the chances of a warning letter significantly increase.
Thank you very much for that. With the threat of the warning letter looming over Dr. Reddy's, and that only time will tell, is the stock looking like an avoid? Do you think there is a further correction in the stock? Hemang Jani is now with us to talk more about individual stocks. Hemang, do you foresee more weakness in Dr. Reddy's?
Yeah, hi, good afternoon. I think, the observations, if you look at the nature of that, is not that serious. And even the plant per se, I think is not contributing more than about 20-22% of the total revenue that they have. So I think clearly there is a case of a bit of an overreaction when it comes to the stock price today. We've seen historically that we will find such incidents happening, but overall, when you look at the growth and the kind of business model that Dr. Reddy's has, I don't think there is going to be a significant impact as such. So I think this dip is a good opportunity for investors to look into accumulation.
Okay, all right. Hi, Hemang. Good afternoon. Thanks so much for joining in. What about Canfin Homes? Every time there's a big spurt, either which direction you hear some kind of rumor that creeps up. We don't have any confirmation, but for the time being, the stock is down closer around 5%. And in the last 90 minutes, it's seen a lot of selling pressure. Would you be a buyer in this dip? Because you've seen this before, right? The stock gets a little bit nervous, then it continues its upward journey. And it has exposure to one of the best positioned sectors as of now. That's the real estate space. Your view?
So yes, I think you keep hearing about certain incidents when it comes to Canfin Homes, which is a bit surprising. I think the management has denied occurrence of many such incidents. So I think because of this news in the market, there is an overreaction. I think Canfin Homes, our view is quite positive. I think within the small ticket size, they have a very good portfolio. Their MIMs, the asset quality, etc., continues to remain good. So I think this correction, one can really buy into it.
All right, we'll take a quick break here, Hemang. Stay with us. We'll just come back with more questions. And I think we're moving towards market closing as well with 10 minutes to go. 20 points on the Nifty is what we have. Stay with us.
CNBC-TV18, embarking on a quarter century of excellence. CNBC-TV18, embarking on a quarter century of excellence.
Welcome back. Just a few minutes to go before we, go through market close. But let's get straight to a CNBC TV18 exclusive then. My colleague Parikshit is joining in with some exclusive news on Ola Electric and their plans of raising some money. Parikshit, tell us more.
Well, this has been speculated for a while now. Ola Electric was supposed to go public by next year, and we had been hearing rumors about this. Now we learned that the DRHP, or the first step towards the IPO, could be taken as early as next week, and we're hearing before the 20th of December. And Ola is looking to raise $700 million through its IPO. They want to list at a valuation of $7 to $8 billion by early 2024. What do they want to use these funds for? They want to use these funds for expanding their electric vehicle business, which includes two-wheelers, charging infrastructure. They also want to come up with electric motorcycles and cars in future. They have shown prototypes on that. The big focus is also on their gigafactory or lithium-ion manufacturing, lithium-ion cell manufacturing, which is likely to begin by February or March next year at the Ola factory. So these will be some of the focus points. We learned from sources that Ola has been increasing its gross margin from minus 5.4% in FY22 to 7.63% in FY23. The company is projecting sales of 0.3 million in FY24 and 0.9 million for FY25. The company had sold about 0.15 million EVs in FY23, and they are hoping to achieve EBITDA profitability by FY25 of 6.6%. Recently, the company had changed its name from a private limited to a public limited company. They had also closed a funding round with Temasek and SBI in October this year to the tune of 3,200 crore rupees. Remember, in FY23, they had reported revenues of 2,782 crores. Their net loss had widened to 1,472 crores due to increase in expenses. The EBITDA loss came in at 1,318 crore rupees, and the total expenses came in at 3,383 crore in FY23 versus 1,240 crore in FY22. Reuters had recently reported that Ola Electric had slashed its sales forecast to 300,000 units from 882,000 units in FY24 and also slashed the revenue forecast.
Parikshit, do we know, in terms of a valuation, what will they be asking for? In the IPO? I mean,
the
a broad
valuation
idea?
that they would be looking for?
Yeah.
$7 to $8 billion is what they're asking for, Prashant. This is what sources tell us, and they want to immediately raise about 700 million from the market.
All right, got that. Parikshit, thank you very much for that. That's going to be a keenly sort of awaited IPO, and that's exclusive story that Parikshit is getting to us. So it's going to be an interesting one. The first kind of, ground-up pure EV company coming to the market in the two-wheeler space. Hemang is still with us. Hemang, any thoughts on this one, on Ola? Or, I mean, implications for what is already listed there?
Yeah, so I think very exciting times, because the first pure play electric vehicle company, if it goes for IPO, I'm sure there's going to be a lot of excitement around it. Yes, the valuation is something that we have to see because unlike earlier, Prashant, what you've seen is that most of the incumbent players have really built up a good capacity and rollout plans. So how much revenue growth, etc., they can expect is something that remains to be seen. But I'm sure in the current environment, there's be a lot of appetite for an IPO like this.
All right. I think we'll once the filing gets done, we'll have a lot more detail in terms of what the business is all about, etc. Apart from what Parikshit has already told us. Hemang, thanks very much for joining us. Good speaking with you here on CNBC-TV18 as always. The market is going to end about 20-25 points higher, just under 21,000. The Nifty Bank did better, and that index will end, okay, not quite. I mean, there also, I think there was a bit of a drop-off which happened. The high was made. The last few hours, the high was at about 240 or so. From 240 on, there's been not a sharp, but yes, there's been a drop down which has happened. But broader markets, mid caps and small caps, coming along very, very nicely with no real give back.
Well, in frontline names, Dixon Technology is one would argue maybe 20 or 25% lower that it was expensive. Guess what? It was up 7% today. JMR Airports, you had a large investor, GQG, coming in there and picking up a big chunk. The stock was up close to around 6%, and massive volumes is what we're seeing out there. JSPL, well, that was a big outperformer from the metals pack. It has valuation support, remember, but post its call and post its earnings, the street was getting a little bit skeptical about its capex plans. For today, though, that was brushed aside. The stock was up close to 5.5%. Strides Pharma as well from the recent lows has been a big mover. For this year, it's up more than 50%. Today, it was up 5%. And the big headline, as we told you earlier, we have a new highest market capitalization company here in the wires and cable space, and that is Polycab. It has dethroned Havells, so Polycab was up and about. Rima.
Well, the other headline is Sensex crossing 70,000 mark today, right? Early in the morning, the Sensex crossed 70,000. The high today was 70,500, closing a shade below that, but with a gain of 100 points. The Nifty 2 ending with slim gains of about 26 points, 0.1% in terms of a percentage move. Pharma dragged the large caps lower. Pharma index was down 0.7%. Dr. Reddy's big loser, 5% gone. Cipla under pressure. All marketing companies like BPCL, HPCL, IOC weak in trade on fears of a retail price cut. Banks sold off, and Axis Bank over there lost ground, 1.5% gone on Axis Bank, even as ICICI Bank managed to close up in the green. Adani Group stocks clocked in some gains. Adani Enterprises Ports ending higher. The top gainer today was Ultratech Cement, a rally of 3.3%. But there goes the bell, and the Nifty ends just a shade below the 21,000 mark. But it's a session in the green for the large caps, and mid caps are firing away. The Midcap index is up 0.75 of a percentage point. We will slip into a break on that note, a quick one. On the other side is Markets Forward. Stay tuned.
CNBC-TV18, embarking on a quarter century of excellence.